What's up, everybody? Good morning. Oh, wow. Actually, let me check this out. Look, there's even like a little, this is where completely from this tick to this tick, that's completely gapped up in the candle. That's crazy. That was before the event came out. That's 40.74, 40.95. Huge. What's up, guys? Good morning. Good morning. Good morning. Hit that like button. Let's go. I'm still on my laptop, but I'm home from the trip finally. So my computer that I'm building is still not finished yet. But I'm going to hopefully finish it today. New computer tomorrow. I'm just looking at what happened here. That's crazy. Look, there's even a gap right here. Look, if you guys check this out, the S&P futures jumped and then tried to fill that gap, and it didn't even fill. There's actually a gap in futures by one tick. That's interesting. That is an impact line if there ever was one. Oh, yeah. An actual gap. Cool, right? I was looking for that. So that is straight up velocity logic at its best. That is exactly what you look for. I wanted a sign that had triggered. And this is even before, at least on the timestamp. Oops. This is even before 7:30. This is like a couple seconds before, according to the timestamp of these orders. Crazy. Okay. So you have an actual impact line from an actual gap. If futures gap, which is cool. You don't see them that often. And there's the run length right there. Seconds after that it moved, and then now we are pushing higher. It's great. Markets opening completely irrationally. Guys, hit that like button. Good morning, guys. Good morning. Good morning. And let's go ahead. I know that's right there. Okay, let's get back and let's do it on Qs. Today, QQQ actually ran in pre-market right up to 300. That was insane to see. Market obviously opening relatively irrational. There's not, if you were long, good for you. I'm long. That was great for me. There's not a lot of activity you can really discern from here, other than I always like to stay bullish when markets are rational to the bull side. And even here, look at this on the tick chart. You've got a gap in the QQQs as well. I mean, sorry, in the NQs as well. An actual gap. That is very cool. I mean, I wouldn't say no. Okay, so I wouldn't say no trade. On the downside, there's always a trade or the style of trading. We say no day trade as in like, don't jump in and try to reverse something, or don't try to jump in and long at the top. There's always a trade to be made, a different style of trade, for instance, an options trade or something. Like a market's move like this, it might not go down, like a selling of a put, or or even being on the long side on any kind of retracement or signal that we do get in the morning. I always take irrational longs for whatever, but I don't long on green candles. I need to get some kind of pullback to something. So we're going to look for retracements or whatever, but this is a pretty decent thing. I read all the reports of everybody's expectations for CPI, and most of Wall Street's, the median range was, I tweeted it, was expected to be 7.2, I believe. And most people, most major banks and quants were labeling a 7.2, a 7.3, coming at a 7.1. Now, again, it's an artifact of it being year over year, right? December to December, we had the biggest bump last December, which means that the change is going to be artificially higher on paper, because December was really high. December was a big bump. So relative to last December, it's changed on a year-over-year basis. On a month-over-month basis, it's not really that exciting, right? So keep in mind, because if you really think about it, you had last year, June, July, August, September, October, November, and last December was a big jump. So with all things being equal, November to December should be a big lowering with a small change, just because you're subtracting the difference between the two, or the change between the two time periods. So because last December was such a big gain, this December, a moderate change is seen as a big beat, just because we're coming, the last year's was such a big change. So we have to also be careful. So this actually, like, I like to look at these, but anytime you have an actual gap like this, I mean, there's no better impact line than an actual half gap in futures, right? You guys see this right here? An actual gap between the candles and the tick chart does show evidence of velocity logic. There is your, and this all happened leading into an interesting, right? Seconds or even milliseconds before 7:30. So either the times are slightly off, there's slight delay in Thinkorswim, or the exchanges are slightly ahead of us when it comes to receiving that information, which you would expect that to be the case. Better, faster communications. There are, the speed of light only is so fast, and the closer you are to the source, the faster you get the news. They invest a lot of money into having really fast technology. You guys hit that like button if you're here. Make sure you give us some love today. I've got my impact ready to go. I've got my run length ready to go. And I'm going to do some yellow lines just to double check. And ES, we smashed through a bunch of yellow lines. Default. Oh, did I do these on the wrong chart? Oops. Okay. Oh, let's remember these. 41, 22. And 40, 64. And 12, 63. These are your run length and impacts, relatively. 11,991. Okay. I always do this. Daily chart. There we go. I was wondering where those were. Let's read it real quick. I'm going to clear out some of the older stuff. Keeping track of all of these guys. That. Oh, we actually cleared all of this impact. So this goes bye-bye. We didn't clear that. Nope, not yet. So see, these are your yellow line calculations. Look at this, right? I love how this works. You keep track of these things. And actually, this one is, even though it tabbed, this one technically was eliminated, so previously, but you can still see there's somewhat of a resistance there. We don't mark it as a resistance once it's been cleared out, but there still can be some. Oh, this was a demonstration. I was wondering where those lines came from. Bye. Clean up just a little bit. Okay. How you guys doing today? What is y'all's take on this? Pretty surprising, right? I'm getting in here a little early just to double check this out. If you think about the CPI, inflation is expected to go down when people are losing their jobs. We've been the group that's been talking about this. Most of inflation is wage inflation, at least from post COVID. So what you're seeing as the unemployment numbers and unemployment filings are going up is that there's more people in the job market losing their jobs, and so anchor points. Oh yeah. These are other demonstrations we did. So as people are getting laid off, they're obviously more competitive to get a job as opposed to, or the jobs competing to get the worker. It's the workers competing to get the job now. So that means that the wages are going to come down, which inflation is going to come down. It's expected when people start losing their jobs in a recession. It naturally curbs itself. At least that part of it does. And that was one of the major driving forces. That and inventory shortages, which again are working themselves out. 4064 and 41 to 22. So that was the run length. Let's just put it there just to have it. It's looking interesting to see this. There's still a yellow line on NASDAQ up here. Let's go ahead and measure those. This is one thing we were trying to mark up here really quick. There were estimates that said if you had a beat that the market was expected to go, I think it was 3 to 5%. The market were to go to 7.1. I think that was the estimate that the I think it was Citi, one of the publications was estimating that. Hopefully nobody was short going into this, right? We teach a lot of stuff about overnight trading, not trading the catalyst. Pretty smart to not gamble on these things against a fundamental reason. In general, it's smart not to gamble in general on these news events. They can completely destroy your portfolio in one little swoop. Okay, so I'm going to measure the yellow line from the impact as an actual gap. That's why I'm writing right there. So let's go ahead and mark it from right there. Even though it's technically here, that's going to be a stronger resistance because it's an actual discontinuity in the price. So mark it right here. So yellow line is we continue to go off of this event. If this continues to become a moving catalyst for remainder of the trading month, we'll use this as a guideline as to where we go on the top side for Q. Let's go back to S&P, same thing. Let's do the same measurement. Let's clean up the chart a little bit. Here's that old yellow line from there, but this also is remove that. Just marking all my levels here. However, that came from way back there. 4200, almost there. Okay. Just double checking the bots today. Making sure actually before I do this, discountables are the same. Okay, even with the new contract, they are the same. $29.50 on Tuesday. Okay, cool. All right, let's get you right up here. And this is actually the March contract, so let's label that. March. Cool deal. Okay, we are opening extremely irrational to the upside, which is great news for bulls. I wouldn't do anything at all close to fading this. I would just, personally, I'm long. I have been long. My expiration's on the 23rd of December, so I've got 10 days for this. We'll see if I get some pretty good premium out the door on this move, and then we'll just see how it goes. I'm gonna make some coffee. I'll be right back. You guys hit that like button while we're waiting. See you in a second. All right, what's up? I'm back. So who today was long all of this? Anybody getting well, no day trading, or well, the idea is on the rational side, I always day trade to the upside. So what I'm looking for is some kind of when we open, I'm going to look for some kind of retracement or some kind of pivot to trade off of. So that's the one thing. Everybody here, smash the like button. Hey, what's up? What's up, Pokey? Mateen, good to see you. Itai, go. So when Rocket Scooter gives me my data in the morning, the next step is going to be to see what pivots I get and what's available, right? It's always going to be risk to reward. Now, remember, a large day like this, volatility is collapsing. So we're going to look for pivots. The first thing I'm going to do is look for pivots in the actual index itself. Then I'm going to try to see if I can't find any volatility pivots, right? So if VIX is collapsing into something, for instance, VIX hits a call wall or VIX hits something, I'm going to expect the S&P to pull back to some level, but I'm not going to expect something this big to return around. You were long gold, Denny? Hell yeah. David, signing that part of your strategy to miss along, but it's all good. Hey, you know what I mean? It was always a trading day. And what's weird about this environment, all three big up days we had were off of CPI, FOMC kind of things. So we're not getting like a, if you look, right, these big ups that we've had, right? These aren't like, the market's not rallying higher. And that's kind of one of the things we were talking about. Now, I'm going to tell you something. It's just moving off of squeezing shorts, but there's also some genuine buying. The thing is that there's just not a steady stream of buying, but you can see the commitment of traders is starting to pivot the market into a very bullish setup. I mean, that's what we said back in October. The market was going to be bullish till the end of the year. And we definitely called it, right? We were very much exactly correct on that actual statement. I will show you some of the things that we were talking about. Let's see my Twitter here. One of the things I'll just retweet this just to kind of say my pinned tweet talking about the actual market bottom for the year. Okay. So this is one of those things that it's just, you know, fundamentals. I mean, I've been doing this for a long time. A lot of this might be your first go in the market. It might be some kind of surprise to know that, you know, things might be acting a little differently than you thought. You know, about 3 months ago, it was gloom and doom. The market was going to crash and collapse. You know, everybody said the same thing. You know, the market's pivoted up in 3 different cycles. We've timed each one of them almost to the exact day. In this particular one, we were like 1 day late. Now, the reason for that is nothing special. It's just experience. And I teach you guys how I do it. You guys have all been here for the ride. Y'all know that it wasn't just a bull run where the market was just green candle after green candle. It just was non-bearish, as we talked about in all of our videos we made. Okay, so, you know, a lot of things are very... guys, if I smash that like button, freaking love the new updates to Rocket Scooter. Did we have a new update today? I think we were supposed... I approved the new update. Did it get pushed? I haven't even read Discord. I was so excited today. Website is up. Did he push anything live today? I didn't get a note that there was anything. Or are you talking about last week's updates? The new updates? Oh, yeah. The new updates are coming are very smooth and very awesome. So we've got all kind of stuff where you can now save chart layouts. You can now save drawings. I mean, there's all kind of stuff. Let me test it out. We're working on, the thing is we're limited with what we can do as we're finding out with the charting widget that we're utilizing with TradingView, since we're just utilizing their charting widget, just this little portion here. Guys, to skip a bunch of steps so we didn't have to create like charts from scratch, right? And they're great, but the thing is that we don't have all the features in their library that they have on their actual like the actual TradingView that you can get. I guess developers are limited in what they're allowed to do and what they can have. So we don't have unlimited flexibility here like we wanted, but we're trying to do a lot of workarounds to get us over while we put all of our techniques into here. Then eventually we're going to make our own charting widget, and spend the time to create that, and that'll be something fun that we do. But in the meantime, you can do a lot of neat stuff. And so let me draw a line there. Let me save this chart layout. Let's call it SPY with line. I don't know if now one thing that you can do, and let me just show you actually before I do that. Here's some of the things you can do. So let's go to like the hourly chart. We have resilience on here. And have you guys played with any of the new features yet? It is Barrios. How often does risk interval change? The risk interval changes when the margin requirements change in the S&P or whatever it is futures. So whenever you see the CME group change what's called the performance bond minimum, you go to the CME margins. It's on the CME website. When they change the minimum that they require clearing firms to charge, like the minimum margin requirements, risk interval will change. So higher margin requirements means higher volatility or higher range of the futures contracts. You just keep that in mind. Does DD only show up during real-time hours? Yeah, it has to be calculated. So DD is calculated once we get 90% of our data points in. The DD starts displaying. So DD is calculated in real time, but it doesn't start displaying until the day. It's a new day, and we got 90% of the data in. So once we start getting all of our data piling in, our calculations of DD. How does the redistribution balance in such a big gap like today? Right, you're going to have a massive half gap, right? So resilience is going to be very important. I can expect resilience to be very high and stay high for the rest of the day. So just keep that in mind. Smash the like button if you guys like that. Rocket Scooter is going to be all over this today. Some of the reasons we talked about the market gaining bullish momentum and that reversal, that was very easy to spot. If you understand the mechanics of inflation and you ignore the news and ignore the yokels on Twitter who gather in herds or spaces or whatever and just reiterate the news for clout, which is what pretty much everyone does, and you just try to think one step ahead of all of that, you'll be the one in the long trade like I was this morning, because you actually have a brain that works instead of a brain that just listens and regurgitates. The goal as a trader is to see something people don't see, and that's what we try to train you how to think like a trader here and not react. When you react, you're late. When you think ahead, you're early, and the gains that you make in trading is not listening to somebody and following their call outs and taking the trade. Again, you're behind somebody else. The goal is to be first, and it's not always gonna be a win, but you want to be as first as possible. The more first you are, the more you sit comfortably while everyone else. Right now, I'm sitting here. I'm going to wake up to probably, $70,000 of profit, and I'm going to sit here and wonder what I want to do with it, right? Well, all you guys are wondering, if you weren't in, well, how do I get in from here, right? So the idea is where's my edge, right, as a trader? And so it doesn't mean I'm some guru gifted trader. No, I just got it right, and I get as many wrong as I do right. And fundamentally, it's really hard to predict the market. You guys have to understand that. But to build a solid fundamental thesis, you just have to understand why things are happening. And the mode of inflation, you're talking heads, we're very much very bearish. And I was the only bull sitting around August, September. I said sometime before quarter four, we're going to pivot and turn around for a very simple reason of this one thing that is always correct. and it's never been wrong. It's never been wrong in 20-something years of this report. And if you guys remember the talks we had about this, didn't we nail it, right? I'll talk about the Commander of Traders report and how it shows risk in the stock market. But this report has, what I'm about to show you guys, if you stick around in 15 minutes, has never been wrong. Never been wrong. Not once in the history of this report. And it was not wrong, and it was not wrong even in this recession, right? And I'll show you guys how to do this in a little bit, but let's open the market and take a look at what we got. Let me see where my trades are today, just very quickly. I'm still on my laptop, just letting you guys know. Kind of like sucks, but my new computer, I'm still working on it. If you really smash that like button, everybody. While you're waiting, let's get the data coming through here. Let's check out Rocket Scooter. I heard there's a data outage yesterday. I apologize for that. Our team was all over it, and it seems that we just had our black box servers were down for a hot minute. Okay, so let's see what we got. Looks like right out the door, we're getting something, right? We don't draw anything until we get, let's get some walls coming through, draw the full liquidity map there. So one of the things we do have right now is just to note the market is opening irrational. The first thing we're going to check is our doomsdays, right? So today, 41.22 is a run length red line. Remember, we talked about volume decay. So as soon as you tap it, entries on the long side will be something that I want to pivot off of this run length. Even though we tapped through and came a little higher, I'm looking for this to hit this and have no volume pivot just to show signs of life. You ever think about using cloud VPS like Paperspace? You don't have to upgrade your computer really again. I don't know what that is. Teach me what that is all about. Okay, so 41.22, I'm looking for that, the S&P. That looks like S&P is what I'm going to gauge today to lead the market over the NASDAQ. So let's just take a look. NASDAQ is 12,166. These are the two major pivots today. I'll write them down for you guys. Let me get a little screenshot here. Okay. Okay. All right. Make sure you guys hit that like button if you're here. Give us a look. Let's go see what Rocket Scooter is saying about the market today. Okay. Let's pull up RS and see what we got. Let's do. Oh, so it's just like a very, very. Oh, that's interesting. Okay, so we have a bull long up. That's easy to see now today. Just take a look, guys. 407 is a pivot for S&P on the upside. Now, again, bull long up to limit itself to 411. So there is a 407, 411 move. There's illiquidity pocket here and liquidity pocket there. So today, I'm looking for the market to do something like that. If it stays on the bull side, that looks good. UVXY. I'll double check that. So bull long up, if you guys look on the liquidity maps guidelines here, I look for these bull long ups to have hedge pressure support back to open. So V-shaped day trades are available even when the market is irrational on the upside. So be careful on VIX. VIX is tapping 7, UVXY. So we do have a pivot in VIX that can happen from here to here, which can give us a little downside for entry point on the long on S&P. Let's do Qs really quick. This analysis is very quick. If you guys first check out Rockets here, you can have a free trial of our software. It gives you all this liquidity analysis. You can get it the same, rocketsphere.com, same name on the website, free, no credit card. Just check it out. You can check out our software. It gives you 3 letters. The 3 letters are code letters for certain things that we teach these things, and you will see that these letters match with these headers at the bottom, which give me actionable pivots I use to trade only this, and I use no technical indicators anymore. Looking to see what's going on with Qs today. What's our data coming through here? Very interesting. There is... I'll pull this up on my laptop here. QQQ 16, 12, 16. Daily refresh. There's a stall on Qs for some reason. So for whatever reason, QQQ is halting on our data pull. So it is still showing Friday timestamp on. So okay, that's good. We'll just say it was fine today. It's fine. All right, so good deal. Yep, thanks, Care. I just noticed it, yeah, as well. We're checking up on that. We'll look at it. Yeah, I'll take a look at it. David's been a lifetime member for a year, and software is incredible. With a guide like me, you've got the best of the best. Bro, love you to death, man. You're so nice. When a Rockstar theory imply that you sit on your hands because CPI move was for risk interval, therefore it's deemed irrational. Not for risk interval, but anytime the market, anytime you move one risk interval, it itself is a catalyst, and the catalyst you mark as well. So that is one thing we should do to get the day started. So if you go to the Discord, right, this is one of the techniques we teach you. Yeah, the market's definitely long. So let's find some long plays in a second. The bot, if you guys use our Discord, Windows, please stop trying to arrange my windows here. Oh, well, whatever. The risk interval bot shows 109 and 29.50. So we're going to go over here and draw a box that is 29.5. And we're going to put that right at the impact. And we're going to just show where that balance point is. So this is where the event took place, somewhere in here. I believe that was it. Wherever that gap was, I think it was actually just one tick below. Yeah, 40.64. And actually it was actually on the same spot. There was just a one tick gap. If you really zoom in, I'm too lazy to do it, but just trust me on that. There's a one tick gap, so I rounded down with the red lines. I'm going to put the catalyst risk interval right here. So this is going to be a green line where the catalyst is in effect. So anytime that this acts as support, we're going to call this, we like to label them, right? CPI 7.2%. Show the name on the right, just so you can remember what it's from. Show the price, sure. And that will be your catalyst, right? So let's just delete that. Oops. And then what that is to show if the market stays. Whatever we have was our doomsday, right? This morning we were already irrational, and then we're irrational the second time because of the catalyst. Now, if you stay above here, then CPI is driving the market further. If you crash below here, then CPI is a non-event. Does that make any sense? All right. Oh yeah, let me message my guys here really quick. We do have some updates, Rocket Scooter. A couple things you guys will notice. You can now minimize the scanner. You can now save your window layouts. If I like save this one, I call it like SPY loadout. Let's just call it something like that, like right. So I can change the ticker, and it will remember my settings, my indicators, and everything. Right? You see, I just changed that window width, and it's going to remember that. I can refresh; it'll remember that. Okay. Oh, to remember my layout, as that is. If I add indicators, it'll remember those. If I load up the chart layout, SPY loadout, right? It remembers I squished it all the way up here. So you can now save chart layouts, which is good. Which means you can put your favorite indicators on there. You don't have to redo your charts every day. We are getting it to where you can save drawings. The next thing is going to be where you can draw and mark up your charts in Rocket Scooter finally and save them. That is something I've been waiting a long time for. We can say goodbye to Thinkorswim, and I can start marking up Rocket Scooter, keeping them that way, which is exciting because I am very excited about saving resources while I'm live streaming. Okay, so nothing's pushed live today for over the weekend, but we'll have a new thing pushed next week. Or sorry, tomorrow. So another thing is if I wanted to draw like here, and I think that will save. If I just click the button here, it saves it. I think that's how that works. I'm paranoid. Let me save it. Yeah, that's what it is. When it does the check, it's saved. And if I refresh, it should remember. Now on the test server, it was that. So I don't know if it's on this version or the one we're pushing live tomorrow. If that line doesn't show up, then it'll be the one that's pushed live tomorrow. And it's probably the one for tomorrow. If I load chart layout, it's called spot loadout. So it should be on the one for tomorrow. But yeah, so we can you can minimize these things. We have it to where you can pop out some windows. You'll be able to multi-chart. All that's coming out very soon this week. So optimization. Well, that's the next thing is optimization. The thing is we're going to do the very next patch is coming out is going to have optimization features. So just when I say a lot of the limitations are limitations of the actual TradingView library and how it communicates with the server. So one of the things we have to do is work with that as we're building more communication to and from the server. It's just, and you know, Rocket Scooter is growing ridiculously fast. We have so many people joining and using the software. It's just, we're expanding into our, you know, we're basically outgrowing our clothes here. So yeah. The sprint to make, real live doomsday bands and risk intervals and yellow lines. Okay, this is the entry point right here to the long side. So a retracement all the way to 411. This is that entry to the long side there, looking pretty good there. Yeah, in the future, we 100% will have our own custom charts. TradingView is like a stopgap because, like our competitors out there use, they might have spent years and years building their own charts from scratch to give you indicators and all that. And since our technology is not the status quo, right? Typically your average indicator salesman out there is going to get someone else's platform and just sell indicators under their platform, right? Like NinjaTrader is big on that. You literally can just wake up one morning, code up an indicator, and throw it on a marketplace and sell it. And you have to require them to get an account there and all that stuff. Ours, we want to be standalone, obviously, our own platform. Our technology's liquidity map, and charting it is just a formality so you can see it. And instead of us spending years of y'all waiting for us to build really awesome charts from scratch and optimizing that, if our product was charts, and obviously we would build our own charts from scratch, our product is like 15 different indicators that are and a scanner and all kinds of stuff in the walls. And all these things are not charts, right? So we built the things that we do first, and we just needed, you guys wanted a display. So we just, we have this as a stopgap while we get you guys the info. And then as the years go by, we'll release and build our own from scratch, a very optimized, very rapid response, very quick acting charts without all the bloat that would slow down, like things that you don't need, right? SPY 407 to 411 is the bounce today. And that's what I'm looking for. Yeah, very bullish today, 100%. Yeah, from 407 at least. So this pullback to here, trading right back up to the resistance. There is a 4-to-1 day trade off of 407 to 411. Yeah. That's what I'm looking for. So let's run the scanner today. So let's take a look at everything that we have. We can pull up the liquidity map current. Let's sort by all the bullish setups today and see what stocks are looking really good. You can see that for all the ones that are at least on the bull side, I mean, everything's bullish, right? So it's hard to pick something that is a loser. I mean, there's not a winner. When the S&P's up, everything's going to look up. So let's actually be a little craftier here. Instead of looking for a liquidity map, let's actually look for things that were decidingly bearish that have broken to bull structure. So ones that are about to break out, right? So let's look for some high volume trading things. TDOC is breaking bear short up on a squeeze. I like those BSU on a squeeze. So when you pull that up, liquidity map's going to show me which ones I like to trade. One of my favorites is this bear short up squeeze. BSU, which is a bull side on positions, but on the short side of hedging that gets the squeeze off of hedge pressure. These are massive. This run from here to here is one of my favorite squeezes. So we can sort by that one. Add in relative volume to scanner. Yeah, we're going to add more scanner features as well as more options data. Like you'll actually show, we'll actually show, let me pull this up really quick. Go back to MHP breakup. Yeah. Yeah, so like I said, before we start adding more features, one of the things we're going to do is optimize. So distance to MHP, and we're looking for things that are breaking out, that are now breaking through. And actually, if I'm going to add a liquidity map and I look for those, just those BSUs right here, these are really good. These are your squeeze breakouts. So something that is already bullish in position, but for some reason kind of maneuvered its way into negative gamma for the month, you're going to look for things that are on that breakout side. So these are going to be your big breakout plays today. If you just load them up, you'll see them. So anytime you're at a monthly hedge and squeezing, that's something that hasn't moved yet, that has power to possibly move if it does break. So what you look for, especially ones that are in between hedge pressure monthly hedge, this is a 3% move from here to here, right? Or 3.3%. It's one point on 30. So when you pop this up, this BSU long from here to here, if I ever do take these trades, again, this is not trading advice, but if I do take these trades, I look for that move to start. So a gamma squeeze, as long as the S&P stays long and strong. I'm looking for breakout plays, something that is popping above monthly hedge pressure. And again, you're getting above it with some volume decline. If we go above it or you tap it, if there's volume, then it's still an active pivot. If you hit it and there's no volume response, just like that video we did you guys like that video, that the redistribution zone video that talks about volume pivots, right? That is my tried and true technique, right? So you hit this level and you have volume, okay, it's still a resistance. If you hit that level again and there is no volume, then it's doing its thing and it's going to continue to go. There is no doomsday number because we have our data providers only sent us 88% of the hedge pressures today. And this happens because our data providers also bottleneck on really busy, crazy days. As you'll notice, even sometimes your trading platforms will do this. They'll lock up, they'll freeze up, or your data, you ever notice like your DOMAX weird? Data or markets just get a little congested on big days like this. So we're at the mercy of when everybody's got their eyes on the market today. What happens is, and they're just like a huge traffic jam, right? It's like CPI moves the market 3% on the open, and then all of a sudden, everybody's at their computer firing trades. Wall Street itself will be a little congested. Now you can get doomsday on the classic app. Keep in mind, we only display it up here when we get 90% of the data, just because we want to make sure that when it's being used for day trading, it's not going to be shown if you're missing some data. Like on big days like this is actual raw DD. And believe it or not, this is a mistake on my part. We're not supposed to give you the number if it's missing 12% of the hedge pressures or 12% of the walls. But it's still here in Classic. So that oversight, I guess we can leave it there just so we have the number. But you guys have to know that this is incomplete calculation. It only has 88% of the stocks, so it's missing 60 of the stocks. Now, granted, it's going to be missing 12 times 5. It's going to be missing probably the smaller caps that aren't going to really matter too much to this number, but it's 90%, right? It's going to be very, very, very high no matter what. So that's good to know. Yeah, so Classic app is still showing it. But because we put a limiter here to not display the numbers until we had all the calculations, just so that you didn't, like, if we have, like I say, our first 5 data points come in, LDD will say 0.2, and you're like, oh crap, it's 0.2, and then 10 more data points come in, it's 0.4, and 20 more data points is 0.6. So these changes in real time as we get more data coming through. We just don't display it until we have most of the data. And that's just to be, thorough. Okay, so I'm going to look for things that are on that breakout side. USO right now is looking to look pretty sexy on that. So all I'm looking for is those BSU setups where you are above monthly and below hedge pressure. So this is a 1 point on that one to like a third. You can actually create a 2-to-1 trade on some of these if you want. So we hit this, there's a high volume spike. So it hasn't picked the direction yet. Anytime you hit it, there's still a rebalance, but you have half a point off of whatever your stop would be if you were doing it. I don't know if I particularly like trading oil in this junction as a momentum thing. As inflation's coming down, you would expect commodities themselves to not have a big effect. But looking for monthly hedge pressure breaks to the upside is definitely a really decent sign of breakouts. So WDC, I'm gonna sort by distance from monthly hedge, like Snap, Futu. These are the ones that are breaking through and moving. So when you turn to positive monthly gamma, you're just looking for something that breaks through here and is on its way up. Like Snap today is a 10 to 10 and a quarter. And of course, I would make sure that at least my stop was at a point where it was at least greater than 1-to-1. So if it's a quarter of a point, I'll typically do like 1 strike distance as a stop. But what I'll do on this one, because it's a quarter of a point, I'd stop at 85, right? I'd force it, make it a 2-to-1 trade. Do you mind the color of the volume candle? No, not at all. Not at all. You guys, appreciate y'all joining in. So these are all pretty nice. Let's look for some Let's get out of just this particular one. So that BSU trade is really, really strong. A gamma squeeze is particularly strong. So anytime you get breaks through monthly hedge pressure on a BSU, you look for it to go right up to there. And again, liquidity map, if you guys haven't seen it before, I urge you to check out Rocket Scooter. We have a free trial. And what we're showing you is market maker liquidity. You've never seen anything like this before. It's very simple to analyze. The algorithm gives you letters. The letters give you a code. This is a reference stock. Eventually, we'll draw the arrows on the chart. But I'm looking for bullish wall positioning. So this is actual, you're actually supporting with real bulls. And then you get positive gamma on market makers longing. So from here, yellow to blue is that BSU scalp. I'm looking for something that is broken through monthly hedge to get that momentum. So broken through monthly hedge to get that momentum to there. And you're watching a free very iso snap, right? These are very solid plays. Resilience is moving higher, which is good. Looks like SPY and other things are going to be popping a little higher. Let's get rid of MHP breakups. Let's get rid of just BSUs. Let's look for any MHP breakups in general. And let's find other breakouts in different setups. Now I have volume here, and you're asking about relative volume. One of the things we're going to do is we're going to show relative options volume traded. So I'm going to do a new indicator that's going to be, I don't know what I'm going to call it, but it's going to show the current at the money option for that expiration, the current at the money option, right? So that example is if Snap Kitchen was 10, what the volume will show you is at the money at all expirations, the total volume ratio of, like, say, again, example, like if we said Friday's expiration, it would show you the volume traded today at 10 over the volume traded total, right? So it's the relative volume of that strike. And it'll give you I'm going to create some indicators basically to show you if the option is illiquid or liquid. So a couple of those, like that'll show you if the options volume is very illiquid versus the total volume that's traded for the day, or the total volume is traded just at that what's it called? At the money strike versus the average at the money volume over history, just to show if something gets a lot of activity or not in general. And then the raw volume at the money option. So you want to see if, when you look at something like you pick a stock from the scanner and you'll say, there's only been 400 contracts traded today on this stock at the money, right? On that contract. And you could say, it's normally 10, right? 15. That's, 20 times the normal volume. Let's check it out. Or you can just say relative to other stocks. So ways to show if options are liquid, just so you can ignore them or filter them out. So an example is you don't want to pull things up that nobody trades because it might look great on the scanner, but then you'll look at it and say, but man, this option's very illiquid at the money. So it's going to have a huge bid-ask spread. It's not even worth chasing, right? Took a stab at Google and JP Morgan. Hey, what are you guys trading today? Will this be recorded? Have to run a meeting when you're about the COT report? Joseph? Yeah. Let's go. Very simply put, COT report over the history of forever has never been wrong in this one particular thing. Never, not once, has this never worked. The thesis was heavily based on this. It's that when market makers are positive and the market's right here. So when this red line is positive, dealers are net long. Market makers are net long. They never drop the bid to find buyers, because when you lower the bid, you are looking for buyers. But if you're net long, you are the buyer. You are buying there. So there are buyers. You're the buyer, right? You don't own the inventory and then lower the price. Like, I bought all the inventory for everybody and I'm just going to lower the price magically and devalue my own assets. It doesn't make any sense. If you own the inventory, you control the price. So when the red line, which is the net positional interest of dealers, market makers, if the red line is positive, the market never collapses until it's negative. Never has that not been true. When this red line goes positive, the dealers always redistribute to the weaker side of the market. So especially if they're long, they need to find buyers. Okay, they need to get out of the long, so the weaker side is the one with the steeper slope. So if the longs are steeper, then they will know that people are buying the market. So they will look for natural buyers, or if people were shorting, they can squeeze out shorts either way. They need to get out of the long if the price falls. Even for the last Great Recession, this had to come down below zero. And as it happened, we had a second wave up the double top, and then we sold. So this is positive. Didn't sell off. It's a great analysis tool. This is the actual positions in the S&P futures, and this is all relative risk balancing of all S&P or risk-based basket ETNs. So these cash-settled instruments and ETNs are going to be hedged in futures, and you can get all the risk of every ETN on the planet, not the ETFs that are share-settled basket instruments. You have ETNs, which are just debt instruments and cash settled, and you can't hedge them by going and buying shares of anything like USO. Is an ETN, right? Anything that's not an ETF, dealers got to hedge somewhere, and they do it in futures. So the futures net holdings is a very, very accurate measure of the positions in Wall Street. These are your net longs, these are your net shorts, these are your market makers. And you can see when they're positive, markets don't crash. So when the dealers are positive, markets don't crash. And also when markets are liquid, they don't crash either. Liquid markets never crash. They never do. Illiquid markets crash. And liquid is when when the green and blue are pointing towards each other or pushing away from each other. Illiquid is when they're pointing in the same direction. So here in general, they're fanning out. So the market is generally very liquid. Buyers and sellers are finding each other. Markets are liquid. Liquid markets do not crash, and liquid markets doubly don't crash when the market makers are long. As you see here. Now, it's not a big, strong rally because, again, we've got QT and other effects, but it's not bearish, and that's very easy to see. And that's all we said. You guys got it? Very easy to see. There are genuine buyers ever since the beginning of October. And the tweet that I made was literally saying that, genuine buyers, right? And so we say certain things, not just to say them. Genuine buying, you can see on my screen right here, right? It's not just herp derp, my indicators crossed over, it's the bottom. This is a very, very, very detailed thread. I actually wrote like a 10-page long dissertation on the market bottom on Reddit. So I find you that link here. I just want to read the bigger detail. Market likely to rally all year. Bad news is good news, a case for the bottom. Right? Let me see if I can't find it. Here we go. If you guys are going to want to read my big master thesis, there it is. If I said on one stream, if hedge pressure and monthly hedge pressure are in the redistribution zone, that wouldn't be as strong a pivot. If I said that, I would have been mistaken. We have no data that suggests that or doesn't suggest that. Maybe I misspoke or something. Or maybe it was a simple case. So in this particular post, I did talk about the 2-month bottom In July, it was another pivot. And then now I'm calling bottom for 2022 and a rally through mid-January, genuine buying. And genuine buying just means this. That's all it means. Genuine buying. Your net long should be becoming more net long. And as a matter of fact, the minute I posted that, it's become more net long week over week. This is the largest genuine buying spree we've had all year. So when markets are doing this, not hopefully being massively bullish, but this is a great call out. And how do we do this? It just comes with experience. You understand that markets don't just collapse when you're bearish. Like I'm definitely bearish over a 2-year run. Like the market's likely not going to find all-time highs anytime soon. It might spend a quarter or two. Next earnings season could get us up to here, but I don't see us breaking a double top. I could see the best case scenario is a double top, and then once QT kicks in, we'll get a second string of rate hikes. I'm sure, even faster rate hikes. But right now, Powell is laying off, and all the commentary and my expectations are 50 basis points, right? And that comes down to the fact that you can predict that was the case, because the reason that they're raising rates is not just inflation. The cost push inflation self-corrects. When people get laid off, well, number one is when people get their jobs back and produce stuff, and your shortage goes away, prices naturally come down. And then when companies are starting to make a little bit of money and they start laying off people that aren't doing much for the company, they can produce the same amount of goods and improve their bottom line and lay people off, saturating the job market. The job pool, the labor pool. And therefore, you have more people and fewer jobs. And JOLTS are coming down, which is another part of the thesis. The number of job openings, right? Of jobs are being eliminated. It's not just people are getting fired because they're bad. Companies are just realizing that job is not producing anything. So it's not like, okay, we have this work from home person. We have 2 accountants on this project. We only need 1. Let's lay off one of them and not replace them. Let's get rid of the job. We can actually consolidate. As we've learned, we sent everybody home during COVID and people are working from home at 10% efficiency, and we only really needed 1 person. So let's eliminate the job. And so now you have an accountant or whatever the job was looking for another job. Earlier in COVID, when people were unemployed, if you wanted to work, you had an advantage. You can go get a job when people were nervous about going in public, right? So in that case, you couldn't, you had leveraging power there were more jobs and workers. So you can say, well, I want to get paid more. I'm taking the risk. I want more return. And that makes a lot of sense. And then as the vaccine came out and people felt safer to go back to work and more people are going to work, they caught that wave and everybody was getting paid these high wages as companies were desperate to get back in and catch up as we were getting some recovery post-COVID. Now you have all these people jumping in at high wages and demanding high wages because of inflation. And now all these companies are losing margins. And that's going to be the problem when it comes to earnings season is margins. Now, sure, you're producing a bunch of goods and making sales, but it costs you a lot of money to do it. So that was really, inflation was a problem because you had to pay people more and you had to pay more for materials and shipments and stuff. But now, as JOLTS are coming down, jobs are being eliminated. You eliminate jobs, you have people now needing a job. They bought a high-priced house or high-priced car, high-interest rate this or high-interest rate loan or whatever, and they now lost their job. Now they're more desperate than picky. And so now they have to accept a lower wage, and the powers go back in the hand of the employer, who can now leverage that demand and hire a competent worker when they create a new job for less money. That is the major driving force for lowering inflation. If you understand that, you understand why I'm calling a bottom in October. People start getting laid off, wages are going to start coming down, and wages are the biggest driving force of inflation. How do you know that if you're not a 10-year trading veteran like myself? Jay Powell said it. Every other fucking word for the last year was job market, job market, job market, labor market, labor market. And everybody here is thinking inflation. Not here, but everybody in Wall Street, inflation, this, quantitative tightening, that. And it's like they're just echoing what's on the surface. In reality, Jay Powell told you exactly what they're watching. We're going to raise rates. Well, we're monitoring the job market. We're raising rates. We're making sure labor market stays healthy. We're going to raise rates as much as we can so we don't crash the stock market, essentially is what he's saying. Because if we crash the stock market, everyone gets laid off again. And guess what? We're back to square one and a stagflation problem that we can't control. And that is something that the Fed will never induce, because that is a stupid thing to do when you have all the power not to do it. The Fed is just selling at the top of the market, right? Getting some risk off their back. But if they plunge us into a recession that's based on stagflation, this is a long entry on 407 S&P. then the Fed has to come rescue us holding 50 times the risk in a stagflationary environment, which is a recession that will be worse than the 2009, 2010, 2011. And talk about the QE run that we had. They'll have to immediately go back to QE just to keep us out of lines for soup kitchens as we will enter a 20-year Great Depression if they crash the market and create stagflation in this environment. That's it. That is it. It's easy to see that. So nobody said that, but as a trader, you just got to think a couple of steps ahead. When you hear Powell talking, what's his motive? He's gonna, okay, market went up, market went down because we changed interest rates. My rates are going up. So as you see, that trend is repeatable. When jobs, unemployment starts to go up, the stock market starts to go up. Because smarter people in Wall Street understand that if people are losing their jobs, then wages will come down and inflation will actually curb much faster that way than with interest rate changes, because that interest rate change is to destimulate. Now, what it does, it destimulates lending by forcing banks to stop giving out stupid loans at high prices. But an example is, if you make the deposit rate or the federal funds rate high, participating banks now can get a higher return depositing with the Fed, then they'll do that instead of loaning it out to like people that might lose their jobs and default, right? So that choice can be made by banks as the Fed can induce or push them into making a choice to destimulate lending. But also when markets are really stupid and rallying like crazy, banks on their own can either be stupid as well, like in 2008, while everyone's giving out mortgage companies with a stupid one, like just loaning money to anybody, right? And the Fed can say, ooh, we need to control that, right? Because they're going to crash the market. But right now, banks are being smart enough to self-govern, right? They're not taking on too much risk. For a little bit, they threw a bunch of people into some really hefty home loans and stuff. But right now, it's a little bit harder, right? So, clearly the raising of interest rates is not going to destimulate that credit. So when you say lending, right, it's a 3-factor approach that causes the markets or the economy to move. And so you have your 3 basic tenets of economics that cause an economic cycle. And I always love talking about the Ray Dalio fundamental. I remember the name of the video that he did, but it's really good at explaining this. It talks about how, how the economic machine works. So basically it talks about the 3 major driving forces of economic growth and depression. So this is the long and true 407 to 411. That's it right here that I'm looking for. So essentially what you get is, production growth. Productivity growth is the slowest of all things that are moving. Productivity growth is the rate at which labor is converted into a transaction between 2 people. So I work, we make something, that something hits the market, and you guys buy it. So every hour that's worked is producing goods like GDP and other things. They have credit, long-term and short-term cycling. Credit accelerates and decelerates the market. Credit normally creates bubbles and pops. It's not really like companies are just doing great, and then all of a sudden Wall Street decides to sell off. It's because people essentially over borrow to the point that risk is too high, and banks say, people have borrowed too much money, and 7 or 10 or 20 years out, they're not going to be able to repay it back because for whatever reason, we can forecast unemployment. So credit cycles as banks get a little bit lenient or less lenient on lending money. And the Fed raising interest rates does also add to that choice for the bank. Well, will you lend money or not to borrowers, or lend it or deposit it with us in the Fed? So that becomes a choice that can be made. And the Fed can trigger and destimulate inflation that way. And inflation can come from people over borrowing or high demand when there's low supply, which is what we had after COVID, which is a different kind of thing. A low supply, high demand environment drives prices up like crazy. And, banks lock you into a loan at a really high price. Now you're stuck in a high mortgage. Damn it, that sucks, right? And now the federal funds rate doesn't necessarily directly correlate quickly with mortgage rates. It's a whole different ball game there. But it's a general principle of rates going up in general, and you look for those signs that rates, if you destimulate lending, then it's going to be hard to get a loan. And so the bubble or the balloon will inflate slower, right? Typically in normal recession, in normal markets, when markets are healthy, and there's an adequate supply and people are getting jobs and the market's just healthily growing, GDP is rising, and all the things you want to see in a healthy market, and credit, like credit to income ratios in general are going up, more people are getting borrowed money to relatively to the income that they're making per worker per hour, then you're going to see markets just cycle up. And if they cycle up way too fast, the Fed's got to kind of slow it down. And this kind of interest rate raise is not actually slowing that down. Right? We're still in for a bear market, so don't be too overly eager on the bull side. QT is going to really affect the markets in a longer term sense. The Fed is not going to go into a period of easing for a while, probably not in 5-10 years. I don't like to see QE coming, period, for a long time. And they don't need to, because the market's actually done really well. I mean, the economy's kind of self-corrected itself. People, we had a shortage, people got their jobs back, we overproduced, then prices came down, and then companies laid people off, and then job market there being fewer jobs and more workers, so wages came down and inflation is coming down, and that's why you see what you see today. And why the markets rallied since October is because smart traders in the room saw that back in October. And they understand that mechanic. And that is the mechanic that is controlling inflation. People losing their jobs, believe it or not. It's great, right? Nice amounts of HP. As long as res is positive, you buy. It was greater than HP. Here's the video. Yeah. So res is positive. If res is negative, right, we're going to drop through and fill the gap. So just keep an eyeball on that today. But things are looking stable. I like it. I like what we're seeing. So when we just see like the CPI numbers coming down, they're just reflecting a direct, it's cool, right? They're directing an actual correlation. And I'll show you guys some of the data points here. The unemployment claims or jobless claims are the biggest part, in my opinion, of what's controlling inflation versus the jolts. You come in here and you can just see that in the shorter term, every time people are starting to lose their jobs, inflation comes down, and that's like one of the biggest takeaways. Hold on, let me go back to, and this is just something cool, right? Investing in CPI. And when you're trying to understand market correlations in traders, what you have to do is see something that nobody sees, and you want to make that really strong correlation on its own. Now, again, you had inflation went up just normally, post-COVID. Why did inflation go up? Because through 2020 and 2021, you just had a shortage, right? You shut everything down and you had a shortage of stuff, so prices were going up and up and up. Now, this is year-over-year inflation, so clearly the change over the year is reflected. It's slower moving. Hold on one second, I got a phone call. But if you look at the month over month, you'll see a very bigger difference. But this is like the year over year from April to April. So the year over year is what's changing. That's what's changed today. And the reason why December is such a big drop is because last December was such a big gain. So when it's year over year, you see how there's like a big delay. It's not like inflation kicked in over that particular month. It's just the change from April to April was the biggest. So this is a year-over-year change. But in general, you're seeing those year-over-year changes pulling back. And that just comes naturally from all the mechanics we talked about. So jobless claims is like, obviously the Fed You see that there's fewer and fewer and fewer people. Everyone's getting their jobs back and getting high wages, and inflation's going up and up and up. And all of a sudden, people are getting laid off, and jolts are coming down. So you know that wages are going to come down. So inflation's going to come down in general. Ever since January of 2022, the month-over-month inflation numbers should come down, and they have been, right? So, and that's the real driving force. And Powell knows that. And he literally was like telling you that every time he talked. And that's just something to kind of keep in mind. Here's the CPI month over month, and you can just see these numbers. And again, it's going to be kind of noisy, but you can see that the month over month since July, right? Obviously, month over month, we did have that inflation all post 20. So, like the bigger changes in inflation took place, like a couple months after COVID, right? Actually, sorry, a couple months after COVID was here, so right. And then we started having massive waves of inflation, and now we're having a big pullback month over month. And this is just relative to what I'm saying. Nothing the Fed is doing is causing that. And that's one thing that you guys just have to take away. And that really is cool to understand. If you guys are trying to learn how to trade or try to learn how to build a thesis, like why would you buy a stock? If you believe the market's going to recover, you can't just think on the surface, because the people in the news aren't professional traders. They're just people in the news. And the news or anyone else, it's like one person says one thing and everybody's out there re-echoing. It's like if you're on Twitter, you'll notice this behavior. Everyone out there sounds smart, but really everyone else out there is just retweeting or reposting someone else's thought. And mostly someone else's thought is always going to be delayed. The people that are out there making the trade, like I long the market because of XYZ, are going to be like, by the way, CNBC, you're long the market because jobs numbers, unemployment filings are going up, and that's the major cause. People aren't revealing their hand and telling you why they make their secret trades or their good trades, because that's their money and that's their income. So the real reason markets move is not like going to ever be published to the public. And we try to teach you to how to think like a trader. And that's the whole point of our streams. That's the whole point of talking about the things we talk about. You have to see what Wall Street sees, because that's never going to be revealed to you. You're never going to read it in the Wall Street Journal. You're never going to read it in someone's tweet. Maybe my tweets, because I like to reveal my hand and pin them like Babe Ruth points at the fence. But as you'll notice, we don't have 1 million followers. There's always you have to kind of dig for the people that know what they're doing. And I have to as well. Like the people I follow that kind of reveal their hand a little bit, it's hard to find, because they're seen as an outcast, right? They're never with the status quo. And so they're never like exploding in a following. They're always smaller because they sit in a circle and they're like the only bull when everyone's bearish, or the only bear when everyone's bullish. And they tend to not have a lot of friends and have a lot of critics, because when they're right and everyone else is wrong, people don't come out and pat them on the back and say, oh my gosh, you were so right. Oh my God, that's awesome. I loved learning from you. You got it. You nailed it, buddy. Oh, you're my favorite. Everyone's usually salty that they were wrong, and they never go pat the winner on the back, like the one winner, right? Michael Burry got a lot of critics, even when he was right for years. And then even after he won his trade, there was no parade in his honor. People were even more hateful towards him, right? It's like nobody likes that one genius who was right, because you lost your money to them, right? You're usually a little salty. So that's the hardest thing. They're never going to have 1 million followers for the most part. Yeah. So you have to just kind of like try to be that outcast. And that's, we take pride in not thinking like everyone else and trying to be one step ahead of the group. And a lot of people here, and we are coming right back in. This is that CPI risk interval. So keep an eyeball on this today. Amelia, these are the numbers, 64 and 22. So let's see how we respond. So now we're at the catalyst part. So the market's now testing this particularly. Now this is interesting to see this mechanic today. Let's walk through and take a look at this. Yeah, no problem. There's that MHP. So if you're swing trading the S&P and you're a swinging bull long, 405.5 needs to hold. So as a long entry point for the long. So the day trade from here to here was one of the things we talked about today, right? The next step is the net positional long for the long haul. Monthly hedge pressure lasts until the 16th of December. So if this holds, this is the entry point for a long to the 16th. This is also where that green line is off of that catalyst. And there you see our risk interval. Watch, here's your high volume pivot at the risk interval. This comes from our catalyst video. So this is what I drew this pre-market. What I love about rocket scooter stuff is they have so many indicators that'll show you where volume pivots are. And there is your high volume pivot at the green line. You see that? When you're accurate with them like we drew, 4093, and I called it CPI right here. That is one risk interval off the impact point. And as you see, as you come to that, there's your high volume spike you were expecting. So now CPI catalyst is no longer active. The market is no longer moving on this number. Now, this could be that mechanic I talked about this morning where they were saying that the year-over-year number artificially inflates or changes this a lot because we had a big push on December, and that small month-over-month change, which really isn't a big change, is one of the things we did talk about as well. Right? The month-over-month is, it's a big change month-over-month relative to last month. But because it's coming down 0.3 off of a very high December, it's going to look like a lot bigger than it is. And that was one of the things we had to talk about today. But just keep in mind the mechanic in general of the stock market is that I don't expect in general the stock market to be green day bullish, but I expect it to be bears are going to get squeezed faster than the bulls are, because right now the continuing jobless claims are people. This is the number of unemployed people who qualify for unemployment benefits. And you can see that there's more and more people becoming unemployed. JOLTS is like acronym, or let's see what this. Can we find it? Yeah, whatever. So just keeping in mind that mechanic is that one thing we did talk about was that on the commitment of traders, dealers are now not very negative, or not very positive. And that was the scary sign. And if you read that Reddit post I made, part of that thesis required the red number to stay positive. And as you see, the dealers already got out of the bag and forced people into the longs. As people understand that the Fed is driving the recession for the most part, unemployment's going up. That's signs of a recession. Well, people are getting laid off because companies are becoming more efficient. Production's still good. Wages coming down. It's normal cycling. And now, but the stock market has moved up. We found a whole lot of buyers. And the dealers, they've offloaded their position. Now the market has room to pivot down. This very well could be the high of the run. We could spend the rest of the year selling off. And today might be that exhaustion pivot. So this is where you make your decision. If you're bullish because of inflation, you're long the long haul at 40.93 for months until earnings next quarter. This is your long for earnings next quarter. If you are short or bearish the market, this was your top for the year. So pick and choose which one you want. Today is the deciding day on the pivot we take towards the end of the quarter of next year, end of quarter one. So today, your decision is made. I guarantee it. This is either the top for the year, or I'm saying the top for the year. This is either the highest we're going since October, or this is the start of a bigger rally. Now, as you see, we've already collapsed in on the catalyst. I say this is okay. Let me start over. I actually misspoke earlier. I said this means that CPI is no longer pricing in. That's not correct. This is the number. It's morning. I'm sometimes I'm still halfway asleep. This 4064. This means that CPI is still active, not the green line. This is a rational sign off of CPI. The red line is where your catalyst is still active, right? So the impact of the event supports right here. So if you are a bull, it's here, not here. Sorry, my bad. 4064 is your long-term bull support for the rest of the year, not 40.93. My bad. And if you are a bull, it's because you are betting that the market is going to get lesser strong rate hikes, like we go to 50 basis points or even 25 early next year. But I'm going to make a bet that around summertime or later, we're getting 1 point, 2 point, maybe even 3 point interest rate hikes. We had that in the early 80s. And a similar concept, but the market was rallying at that time. And when the market's nice, healthy, and strong, the Fed has like driven this boat to like the perfect lane and the perfect weather. They can really raise interest rates rapidly and the market wouldn't care. And that's, I think, what they're trying to achieve is that they can raise interest rates to slowly pull back to give the market some confidence or hint that they're pulling back, which is like slower rate hikes. And then once the market stays healthy and is liquid and they've got their liquidity, they withdraw their liquidity and the market's liquid, then they just turn on the afterburners and raise rates into the rally, which you'll see that happens a lot in recoveries. From 1996 to 1998, Alan Greenspan did the same thing, massive rate cuts leading into Clinton's second election in 96. And then the market started rallying like crazy and they started raising rates and the market didn't care in the late 90s. And that didn't care mentality led to the dot-com bubble, right? There was so much hype and hoopla off of the dot-com that people didn't care about the rate hikes, did not pull the market down over the period of 96, 98 when Greenspan was raising rates, same thing. So I think that Powell's going to taper off now to keep the market from collapsing, to keep people from getting massive waves of unemployment and losing their jobs. And then when the market's healthy, which it is healthy-ish, they start raising rates faster and we won't care. Nobody will bet against it. Companies will have plenty of time for whatever. But if you're a bear, the fundamentals of the bearish side are a little different. What you're betting on is that companies quarter to quarter are going to show lower margins on their lower profits, basically, because of lower margins. The cost of materials was high and labor was high back in the day, and a good was produced, but there's a cycle time that good is bought. For instance, you're producing 100,000 things per month, and people buy 10,000 per month. Well, it takes 10 months to get through all the things you purchased. So there's a 10-month delay before what you produced clears out. And then the next wave of what you produced, maybe you bought it cheaper, had cheaper labor, but you have to cycle through all the expensive stuff with low margins that you already produce, high wages and high prices and low supply. So we have that mechanic that you're going to bet on. If you're a bear, you're betting that earnings are going to show less profits. Higher sales, higher revenues, less profits. So that is the major mechanic, if you guys understand, for the bear side of the market. It's not inflation. You're going to bet on company health. So when earnings come out, sales are great, margins are down, profits are down, which again will lead to what? More layoffs. And so companies lay people off to improve their bottom line. If they're not making money, they're going to trim further. And that's the mechanic that causes the bear market. More unemployment. But also that more unemployment will also pull inflation down. So there's kind of this interesting balancing act. I think it's why the Fed is playing this game so beautifully, because there's so many self-correcting mechanics in the market that you don't have to even think about. Companies trim 5%, market's going to rally because that improves your profits. The companies lay people off to improve their margins. And less labor they have to pay on the overhead, more margins. Higher margin. Yellow resilience line is strong negative. Do you expect lower prices? No. So the yellow resilience line just means at monthly hedge pressure, I don't expect it to hold. And as you see, when we got to it, yellow resilience was negative. It's telling me that the majority of the stocks are not holding their monthly hedge pressure. So that's telling you that I'm not expecting this to hold over the course of the day. This pivot from 405.5 to 407 is likely to take place very rapidly. But when it hits 407 and this yellow line is still lower, if I were long here, I'd probably exit there today. If this yellow line is negative, here, I don't expect monthly rest to hold that easily. Now, again, markets are irrational, so In irrational markets, we don't really formulate these relationships, but in general. So in general, it's looking like the markets are not going to hold monthly hedge pressure. 405.5 isn't going to want to hold. Resilience, however, is the reason it's called resilience is resilience typically doesn't care if markets are irrational. Resilience is the standalone best indicator you can use, rational or irrational markets. Resilience pretty much always does its thing. The one thing is in irrational markets, resilience just doesn't have any leading edge, right? It doesn't lead things. You see today, resilience, as you get to it, is right around zero and hovering zero. And then we say that in our rules, right? Irrational markets, which we have flagged today. Resilience is not going to be a strong leading indicator, but it still is going to do its thing. And so resilience is positive right now. So 4.6 is likely to hold until it goes negative. But as you see, it's not leading. So it's probably just going to track the market today. The yellow line is monthly hedge pressure resilience, and that is the tiebreaker at the yellow. And it's negative right now, which is telling me I don't expect 405.5 to be a razor sharp pivot to bounce and rally really hard. It's going to be a very hard fight right here. And I'm a little nervous that the market might actually sell off, which this is going to be Wall Street's pure sentiment. And if this is the top, this was the top today, right? The Fed doesn't want a high stock market. They need inflation down 2%. Right, they don't want a high stock market, but they don't want a low stock market either. They want to drive the stock market slowly down so that companies can lay people off so that wages can come down. Inflation will control itself faster. It's like if you think about it, the Fed is like, we need to induce companies to lay off all these stupid stay-at-home, work from home, Netflix from home employees who just have silent quit, right? Or when they quiet quitting, who really don't work but still get a full paycheck. And the Fed's like, we need to induce those people getting laid off so that companies can, wages can come down, right? Fed's trying to induce low wages through their, right. So that's how they're going to get inflation down. Yeah. And I completely agree with you. The yearly 2% target is what the Fed goes for. They want the stock market to come down just enough that you lay off 5% or 10%, but they don't want the market to come down where you're laying off 30%, 40%. That's a bigger problem. You lay off just enough, margins get better. But if you lay off too many, then production goes down and then you hit that other curve. So they compete with each other, right? More workers is more production. But if you have people that are working with a full salary but not really working and not really needed, you need to get those out of the workforce for a little bit. And it's going to be sad for a little bit. Now that's less people making money and spending on stuff, which means there's more of a surplus of goods, which means prices will come down, right? There's less shortage. We've already cleared that out. But then also there's fewer people with money in 401ks, there's fewer money going into the stock market, which means liquidity comes down, which is bad. If you lay off too many people, the market becomes illiquid too fast. So they want to drive it just a little bit, let the market stabilize, drive it harder, let the market stabilize, drive it really hard while the market's rallying. It might be like a threefold wave. It was like a saying that you're going to see 50, 75 basis points, and then you're going to see 50, I think, this time, and then 25. You might see 25 basis point raises, and people are going to be very eager, ooh, the Fed is going to stop raising rates. And I don't think that's true at all. They're going to slow down and still raise rates or keep them the same. And then once the market starts rallying off of that, then they're going to raise rates faster into the rally so they don't crash the market and create hyperinflation or hyper layoff, right? And this is a common technique that the Fed has used historically, actually. And when I'm not reinventing the wheel here, they do this strategically. Can you trust resilience? Resilience is going to likely track the market and not lead the market when it's irrational. So resilience, while it is positive, might not be leading today. So it is, I trust it, but I also use risk and reward. So just be careful, right? Monthly res is less than zero. So be careful that we don't lose that level. I'm going to call it a day in a little bit. I'm glad to see all you guys turn up. Make sure you grab Rocket Scooter's free trial. Go to rocketscooter.com. It's a free trial. If you guys like what we do, go there. Free trial, 7 days, no credit card. You guys can check us out. Our Discord is also free. Chat room at least. check it out. We love you guys, and we ought to see what it is we do. You can play with the scanner. You can play with all the stuff that we have. And give you guys some tutorials later. I'm going to get back to building my computer. Hopefully I'll be live tomorrow with the camera back on. And we will see y'all later. Y'all have a wonderful day. Head over to the Discord. We'll continue the chat there. Be very careful today. Watch out. Remember, markets are rational. Watch that one pivot I mentioned right here, 40.64. This is either going to prove that this is the top of the entire market for the year, or this is a continuation. Was this that exhaustion high that Wall Street was waiting for? Be careful. Be very careful on this one. If 40.64 holds, which my guess is, I am very, very on the fence. I believe it will hold, but it's like, I'm like 51% certain, because that commitment of traders, the dealers are now net negative. They have no desire or incentive to keep the price anywhere. They've now redistributed their positions, and now the market is pure sentiment. It was market maker driven for the first couple of months of this wave. Dealers had to squeeze out shorts and find buyers. That's what they did. And now they found them, and now they offloaded their position. And markets tend to stay floating while they're positive, and now they're negative. As the last 2 weeks, right? Dealers are negative. So that is the big curveball thrown at the thesis. That's why today is a deciding factor. And all people are going to care about now is going to the FOMC meeting. And I'm like 95% sure we're getting a 50 basis point raise. On the surface, the inflation numbers are coming down, so the Fed can create a little more stability and safety in the job market by doing something that's less strong. And that's where we go from here. It's going to be very, 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 very... it's going to be... Sentiment is going to rear its ugly head right here. If we clear out 40.64, then it means CPI was priced in already. If we lose it and it becomes, you hit it and it loses the volume and we're dropping below, this is the high of the year. Papa's going to get back to being short. We're going to look for monthly hedge pressure breaks, so be very careful, you guys. Okay. Again, I'm 51% that it's going to hold. 64 is going to hold. And I'm 51% that we're going to likely hold it and stabilize, hopefully somewhere in here. We'll see. Okay. Adios. We'll see you tomorrow.